Very pleased to welcome Aaron Dunn back to the show, Keystone Financial. Aaron, thanks for taking the time. And this is so timely because we just had this big week. On Thursday, we had the Federal Reserve come out, maybe advancing the scenario of higher interest rates coming sooner because of inflation. What's that done to the side of the market that you spend so much time on? Have had an excellent track record, which is looking for, at times, I love the way, by the way, at Keystone, they always say, hey, this is an aggressive stock. This is a growth stock. This is strictly an income stock. Those kinds of things. But you've been focusing on the sort of growth/income kind of area. What has the new sort of debate about inflation done to that side of things?
Well, I mean, obviously, inflation has really been the topic of the day. Everybody's been talking about it. And what we observe is just how crazy it is, just how quickly things can change. I mean, if you look last year, everybody was interested in what I'd call the new age investments, the high tech, the AI, cannabis, renewables. And now this year, that has shifted to the more old school type of investments like the commodities, banking and energy infrastructure. I've heard that referred to as grandpa's revenge. And it really is in a way, grandpa's revenge because people are gravitating back to those older stocks right now. In terms of what we do based on a Fed announcement, what we do is we try not to react to it. And that's what we see a lot of people doing is the Fed makes an announcement, they're thinking that they may start to raise rates in 2023. Our view is that the Fed has no idea what's going to happen in 2023. They have absolutely no idea. So you really can't trade on that. And I know that for most investors, trying to follow the ups and downs, the announcements of the Fed, where investor sentiment is going on a week-to-week or month-to-month basis can really make you crazy because there's just too many moving parts. And it can actually make you broke if you're trying to follow that with your investments. I mean, if you're trying to follow the crowd every time investors in sentiment shifts, last year you're heavy into those new age investments, but then once you start to hear people are shifting into older school investments, you're just moving your portfolio around like that. We believe that's something that can actually make you broke. So our strategy, the way that we think investors need to formulate their portfolios is don't try and be a forecaster. Don't try and predict what the Fed is going to do in 2023. The Fed doesn't know what the Fed is going to do in 2023. So how does an average investor know that? And how is an average investor going to take that information and actually turn it into an actionable investment decision? What we believe investors need to do is they need to build a focused stock portfolio that consists of a mix of different types of companies in high growth areas, but then also in stable dividend producing areas as well. So if you look at the way that we advise people to build their portfolios, there's always that, you've talked to Ryan before, he focuses on the small cap growth stocks. So getting those growth oriented companies in your portfolio, companies that are in markets, serving markets where we see that growth as being sustainable. And where really these companies are providing some type of an essential solution to a problem that society faces, and they're benefiting from that, and they're generating profit from that. But then also mixing in some more stable companies, some dividend payers, some companies that are going to bring some income into your portfolio, where the financial performance of that company isn't going to be so variable in line with what the Fed does or what GDP growth is next year, where you have good visibility of cash flow. And we find when you mix those companies together, you really set your portfolio up to do well in a variety of different economic scenarios. And it doesn't rely on you being this forecaster with a crystal ball, knowing exactly where commodity prices are going to be or what the Fed's going to do or what inflation is going to be 6 months or 12 months from now. You want to position your portfolio in good, high-quality, profitable businesses in a variety of strong markets where that portfolio is going to do well in a variety of different scenarios. And that's really what we are advising people to do. And it's been a highly successful strategy over time.
And I'll ask you for a couple of examples in a minute, but first I want to come back to one you recommended to us. It's a sort of a case study approach, and tell us a little bit more about how you go about it. Not, obviously you're spending hours and hours, and I give you 2 minutes to do it, but it gives us a sense of it. You were on with us going back just over a year, so about April 2020, and you talked about Brookfield infrastructure. And infrastructure is a popular theme now. And I remember you talking about it was about $51, $52. Now it's $66. What, how do you know, is it time to sell, or is this exactly what you thought would happen? That kind of thing.
Well, we're always reviewing the business. We're always, every time there's something that we can review, like financial results, maybe a change in an end market, an acquisition, we're always reviewing the business and making sure that it still fits our criteria. So just on the example of Brookfield Infrastructure, that's just a great example of a company that has very high visibility of cash flow. It's a very stable business. About 90% of its revenues are contracted, so they know what they're going to be. There's not a lot of variability with the ups and downs of GDP. About 70% of the revenue is indexed to inflation. So if we get that high inflationary environment, there's some offset to that, and it paid a great dividend that continues to grow on a yearly basis. So the more you put that research in, you identify these individual opportunities that have those great fundamentals, the better you're going to do over time. And I mean, you look at a company like that; they're in toll roads, they're in ports, they're in energy infrastructure, they're in data infrastructure. Right? None of these things are going away. They're all going to continue to. They're essential businesses. And that's what we like to invest in, companies where we have a high degree of confidence in their ability to continue to do well over time.
Aaron Dunn is with me, Keystone Financial. I want to tell you about something, though. I joked about it. It's time for summer school. I know it doesn't feel like summer. Some places it feels like uber summer in other places, but everyone can participate. We've got some webinars planned for you to talk about your portfolio. Just heard Aaron talk about that a moment ago, about the importance of the kind of portfolio mix that you have. And they're going to talk specifically about that. It's two webinars coming up, June 29th at 7 p.m. We'll do Pacific time here, Mountain time obviously adjusted, etc. June 29th, 7 p.m. Pacific, and July 6th, 4 p.m. Pacific. You want to check it out, go to mikesmoneytalks.ca. I put it right up there because I think this kind of stuff is so important. The more you know, the better it is going to be if you want to be successful. So it's Keystone's Summer School for Your Portfolio, live webinars. You'll just be able to do it at home. June 29th, 7 p.m. Pacific, 8 p.m. Mountain. July 6th, 4 p.m. Pacific, 5 p.m. Mountain. Just go to mikesmoneytalks.ca to register. Aaron, just before the break, I was asking you to give me a little example, like with Brookfield. Do you have any other? Give me a couple of. I'm putting you on the spot, I know. Give me a couple of other new ones.
Sure. So I have two companies that are quite different. So I'm going to start with the dividend payer. This is Enbridge ENB on the Toronto Exchange. So this is the largest pipeline energy infrastructure company in North America. And the reason why I'm talking about Enbridge is that it's really unique in terms of a dividend growth stock. It pays a yield right now of nearly 7%. It is growing its dividend on an annual basis, about 26 consecutive years of dividend growth. And they have a strong capital investment pipeline in place right now, where they are forecasting continued growth going forward over at least the next 2 years, most likely beyond that, of about 5 to 7% per year. So this is a company, this is definitely not something that I would consider exciting, but it's very unique in the Canadian dividend space, whereby you can find a company with a yield that high with such stability of cash flow underneath it supporting that dividend. So 98% of their cash flow is based on long-term contracts. That gives you very strong stability going forward in terms of their ability to maintain the dividend. And then they also have that embedded growth. Now, in the pipeline space, the big risk, and what I've always talked to our clients about, is the political and environmental opposition to getting any new projects through. I mean, it's always a fight for these companies, but Enbridge has been successful in advancing some of their projects. They have a big one, Line 3, which looks like it is going to be complete at the end of the year. So you have a great yield, stability of cash flow, dividend growth, and you combine these things together. And I think that, one of the things investors need is they need yield. I mean, bonds aren't paying anything. So they need to look at some high quality dividend payers to start to supplement that. And I think that Enbridge is one company that has the fundamentals to do that.
Well, one of the things that you just mentioned, but it's something to just remind people, like when I see somebody's paying a good, strong dividend, I want to know how safe that dividend is. It's not like a bond where you're guaranteed to get the interest or there's trouble, or you can come after the bond, the company that issued the bond. It's like a mortgage. The bank can come after you if you don't make your mortgage payments. Well, that's not the case. I mean, dividends are not guaranteed. So you always want to look at what's the cash flow to support that dividend. And your point's very well taken where you say it's not even an iffy cash flow because they've got contracts that spell out what they're going to take in that produces the cash flow. So I think that's an important part. One of the things that jumps out at me, though, just a quick question is, I look at Enbridge. Why isn't everybody owning it who's interested, as you say, in yield primarily?
Well, I think that a lot of it comes down to investor sentiment. So they do have, like I said, a lot of opposition when it comes to advancing their large-scale projects. They tend to always have negative news in the press. And for that reason, people look at the 7% yield a lot of the time if they don't know a lot about the company and they think, well, maybe that's too high risk. Maybe that's not sustainable. And that's why the yield is so high. And, to your point, you're 100% right. Absolutely no corporate dividend is guaranteed. So we never guarantee that a dividend is going to be sustainable. But it really comes down to the research, looking at the underlying cash flow, how stable it is, how visible it is going forward, and does it cover the dividend? And, Enbridge checks all of those boxes. So for us, Enbridge is a modern day value play. It is a value play. And typically when you're investing in a value stock, there's some reason that that more investors aren't piling into it. And we believe that a key reason is just the sentiment and the opposition to new projects.
But this is a great example, by the way, of why, as you know, I've known Keystone Financial. I didn't even have gray hair when I first met Ryan, going back. And you had hair when I first met you.
And now my hair is gray and I have lots of it, yes.
Yeah. But my point is, so this is a great example of why you use a professional service with people who've got a track record. I know that stuff about Enbridge. I'm just happy to have Aaron do the research for me. I know what I would like to know. I know the questions I have, as I say, is how safe is that dividend? Well, he'll look at the cash flow. He'll look at how contracted it. Really, it's just it's an infomercial for why you get professionals to do the research for you, like Aaron has on Enbridge. So that's what just occurs to me when you say that stuff, because I know the questions, but thanks for doing the research.
Another reason why you want to get us to do the research is because you don't want to spend all day in front of your computer looking at financial statements like we do.
Yeah, exactly.
We like
give
it.
Me one more quick one. One more quick one before we go.
Sure. So NV5 Global. So this is in our U.S. growth stock space. It is not a dividend payer, but what this is an investment into the U.S. infrastructure build. So U.S. infrastructure is crumbling. There's a report put out in 2017 by the American Society of Civil Engineers about a $4.5 trillion investment needed to upgrade it just by 2025. So this company has been benefiting from capital flowing into infrastructure construction. They're an engineering consulting firm, so they don't take the same risks that a construction company would take. They also have made acquisitions into the geospatial space, which is a more recurring revenue model business. But we like the company. We like it because they've been successful even without a major stimulus package at the U.S. federal government level. Obviously, there's a lot of talk about stimulus going into infrastructure. If there is a major stimulus build, this company really benefits from that. If there is not, they still have strong growth drivers in place. So it's NVEE on the NASDAQ exchange, and we just think that it's a solid play into infrastructure build. That's a thematic investment, but it's underpinned by a company with very strong profitability, growth, and a solid balance sheet.
But it's another example of when someone, and this is for everybody, when you look at an investment, one of the things that Keystone does, but everyone should do, I know Victor does this, you start saying, okay, where does it fit in my risk profile? Everything can sound good, but is it appropriate level of risk? And that's one of the things I've been saying, Aaron, just about where the market's at recently. I said, I don't have a crystal ball here. But what I can tell you is this is time to review your portfolio. What risk are you taking? Do you want to lighten up? Do you want us to have some cash? Whatever it is. But that's how you guys do it at Keystone, which I like, is that you tell me, okay, here's a recommendation. This is the risk category it fits in within your portfolio. And I think that's just key. As I say, you guys do it by rote, but it's key for people to do that because it's really all about risk management in the end. And I guess that's what your seminars are going to be talking, obviously, about that coming up on the 29th, the webinar rather. 7 p.m. Pacific, July 6th, 4 p.m. Go to mikesmoneytalks.ca and get the details. But that's exactly why you talk about portfolio construction.
Absolutely. I mean, most investors don't want to fill their portfolio 100% with aggressive risk stocks. Right.
Yeah.
I mean, some investors are going to need to mix some more conservative stocks in there, but they can still have some aggressive companies, some higher growth companies, even if you're a low risk investor, just to augment that return. So it's about building that portfolio that has a mix of different companies. As I said, you're going to have the growth oriented companies, you're going to have some dividend pairs, some defensive names, some exciting names. Getting that mix down is really the key, we believe, to long-term success in the market. And then pinpointing the right stocks within those categories as well.
Sure.
Good, profitable, growth-oriented businesses.
Well, I'll remind people, go to mikesmoneytalks.ca. It's a free webinar. You can go on you can take place on June 29th or July 6th. Get the details there. Aaron, thanks for taking the time.
I appreciate it. Thank you, Michael.